Hello everyone. The topic is Financial Accounting 3 for today's session. Program Commerce Semester 3 University Mangalore Session 67. Recap of previous class. To make distinction between dissolution and sale of firm. Need for dissolution and sale of firm. Learning objectives to make the students analyze the concept of purchase consideration and its calculation to prepare them for accounting during dissolution and sale of partnership firm. Learning outcomes. Students are able to analyze the concept related to dissolution of partnership firm. The students are able to prepare accounts on sale of firm and piecemeal distribution. In session 67, the topic is gradual realization of assets, or it is also known as piecemeal distribution of cash. So in this topic, we can discuss about the meaning of piecemeal distribution of cash. In dissolution of firm, it is assumed that all assets are realized and liabilities are paid out on the same day, and the realization profits or loss, if any, is transferred to partner's capital account. But in actual practice, this assumption is unrealistic and doesn't happen because all assets cannot be realized on the same date and all the liabilities cannot be settled on the same date. As it is a gradual process, it takes time for realization of assets and payment of liabilities. The assets are sold piece by piece or stage by stage, and the liabilities are paid stage by stage process. And as such, it is known as gradual realization of assets. To conclude, piecemeal distribution of cash means here the assets are sold stage by stage and the liabilities are settled process by process, and as such we supposed to call it is a piecemeal distribution of cash or gradual realization of assets. In piecemeal distribution, the aspect we have to discuss is here the order of payment of liabilities. Generally, the cash available from the realization of assets can be settled in the following order. The first payment is realization expenses. The second one is secured creditors. The third one is unsecured creditors. And the fourth one is partners' loans or advances, if any, given in the problem. And finally, the fifth is the settlement of final capital between the firm and the partners as concerned. So as we mentioned, the order of payment, the first order of payment is realization expenses. In actual practice, the realization expenses are not known in advance, but a firm can set aside a proportion of amount for the realization expenses. And whenever the realization expenses arise, they can meet the realization expenses from this amount. But if there is any surplus, it has to be utilized for the payment of other creditors. But if the realization expenses are clearly known, they can pay exact amount of realization expenses as given in the problem. The second settlement is secured creditors. The secured creditors are those parties who have specific charge or floating charge on the particular assets. And whenever such assets are realized, it should be paid in the second stage. The third one is unsecured creditors. It includes creditors, bills payable, general overdrafts, loans, outstanding expenses, etc. These are paid proportionately in the third stage after paying the secured creditors. The fourth is payment of loans and advances of partners. If there are more than one partner, the payment should be made on pro rata or proportional basis. Lastly, the partner's capital. Payment of partner's capital according to their capital contributions or claims are paid in their profit sharing ratio. The next aspect in this topic is methods of piecemeal distribution of cash. Generally, there are two methods of piecemeal distribution of cash. When the capitals of the partners are not in their profit sharing ratio, The following methods of piecemeal distribution of cash among the partners is followed. The first one is surplus capital method. The second one is maximum loss method. The first, as we mentioned, surplus capital method. It is also known in different names like highest relative capital method, excess capital method, or quotient method. In this method, when a partner's capital are not in their profit sharing ratio, first we have to identify the cash available for the distribution among the partner should be paid to those partners whose capital are more than their profit sharing ratio, so as to reduce their capital to their profit sharing ratio. After this, the available cash is distributed among all partners in their profit sharing ratio. Thus, we have to follow the following steps. In step 1, we have to calculate the actual adjusted capital of the partners. The actual adjusted capital is nothing but the capital balance available in the balance sheet and any reserves or profits transferred or any deductions in the form of profit and loss which is given on the asset side of the balance sheet. Finally, we can come to the adjusted capital or final adjusted capital of the partners. Once we get the final adjusted capital, the second step is we have to take into consideration the profit sharing ratio of the partners. In profit sharing ratio, we have to identify the smallest quotient of capital of the partners. So there may be more than one or two partners. In that case, so normally we have to identify which partner has small proportion of capital, and that small proportion of capital will be multiplied into their profit sharing ratio, and thereby we will deduct that proportion of capital from the available adjusted capital, and thereby we can determine the smallest quotient of capital. Once we determine the smallest quotient of capital, we can identify the surplus capital available among the partners. The surplus capital, after identifying, whenever the amount available, the surplus capital is paid at the first instance. After that, the balance fund available for the settlement will be paid in their profit sharing ratio or proportionate to their profit sharing ratio. So this can be explained with an illustration which is given in the study material enclosed to this video. A, B and C are partners having capital of rupees 75,000, 45,000 and 15,000. Their profit sharing ratio is 3 is to 2 is to 1 respectively. Calculate the surplus capital. And if we go for the solution of this problem, the profit sharing ratio of the partner is 3 is to 2 is to 1. Actual capital given in the problem is 75,000, 45,000, 15,000. Now we can divide capital of each partner by their respective share, that is 3 is to 2 is to 1 according to the smallest quotient of capital. In this problem, the smallest quotient of capital which belongs to C, that is 15,000. So thereby 15,000 into 3 will get 45,000 in respect of A, and 15,000 into 2, 30,000 for B, and 15,000 into 1 for C, 15,000. So now we can determine the surplus capital. In this problem we have A 30,000, B 15,000 and C nil. Again the same step can be followed in the next stage. Now B and C have a capital of 22,000 and 15,000, that is A and B have 22,500 and 15,000, and their profit sharing ratio is 3 is to 2. So in this stage, the smallest quotient of capital which belongs to B. So now we can multiply. For 2 share, B has 15,000. That means for 1 share it is 7,500. So therefore A's surplus capital can be determined by multiplying 7,500 into 3, that is 22,500, and for B 7,500 into 2, 15,000. Now if we deduct, A has a surplus capital of rupees 7,500, B is nil. The order of payment in this stage is, first we have to pay 7,500 of A. Next we have to pay 22,500 and 15,000 of A and B in the ratio of 3 is to 2 till it becomes 0. And finally, the available balance, if any, is paid between A, B and C in the ratio of 3 is to 2 is to 1. That is rupees 45,000, 30,000 and 15,000 will be paid respectively. So this is what we call as the surplus capital method. The second method what we mentioned is maximum loss method, which is not in our syllabus. So therefore we ignore this method from the calculation. Thank you for watching the video.